Now, question 11. Which one of the following is a measure of debt service capacity of a firm? Which one of the following is a measure of debt service capacity of a firm? The current ratio, the acid test ratio, the interest coverage ratio, the debtors turnover. Now, when you talk about the measure of debt service capacity of a firm, this refers to its ability to meet financial obligations related to debt, particularly the interest payments and sometimes the loan principal repayment. Now, for us to be able to tell which is a measure of the debt service capacity of a firm, the right answer is the interest coverage ratio. The interest coverage ratio shows how easily a firm can pay interest on its outstanding debt from its earning before the interest and taxes. So it measures the debt service capacity. The interest ratio equals to, when we calculate the ratio, we use the formula, the interest coverage ratio equals to earnings before interest and taxes divided by the interest expense. So it measures how many times a company can cover its interest payments with its operating income. Now, what that means is that if you are able to get a higher ratio, 4 or even more, means a strong ability to service debt. A lower ratio indicates a financial stress or a risk of default of repayment of debts. But now, when you look at the other options, for example, the first one, we have the current ratio. When you talk about the current ratio measures the short-term liquidity and not the debt service. With the formula, in that current ratio equals to the current assets divided by current liabilities. When you talk about the acid test ratio, which is the quick ratio, this is a stricter liquidity measure than the current ratio. It excludes inventory from current assets. Still, it's more about the liquidity and not the ability to service the debt. When you talk about the debtors turnover, this measures how efficiently a company collects receivables, accounts receivables, or collects money from its debtors. The debtors turnover equals the net credit sales divided by the average accounts receivable. So it's about collection efficiency and not the debt repayment ability. So the best option in this part is the interest coverage ratio. Question number 12. Which one of the following statements is correct? A higher receivable turnover is not desirable. Interest cover ratio depends on the tax rate. Increase in net profit ratio means increase in sales. Lower debt equity ratio means lower financial risk. Which one of the following statement is correct? A higher receivable turnover is not desirable. Interest cover ratio depends on the tax rate. Increase in net profit ratio means increase in sales. Lower debt equity ratio means lower financial risk. The best answer here is the lower debt equity ratio means the lower financial risk. So from even the previous question, we have said that when you talk about, okay, no need of going back. So when you talk about lower debt equity ratio means lower financial risk, the debt equity ratio shows the proportion of the company's financial that comes from debt versus equity. So a lower debt equity ratio means the company relies more on equity and less on borrowed funds. Equity is about the money that is raised through the sale of the company's shares. So this reduces the financial risk because the company has fewer interest obligations there's lower risk of default. It's more stable in times of lower income or even downturns. So the less debt, the less risky, making this statement correct that lower debt equity ratio means lower financial risk. Why the other options are incorrect? When you talk about a higher receivable turnover is not desirable, this is incorrect because receivable turnover ratio measures how efficiently a company collects money from its customers. So when you talk about receivable turnover, it means which equals to net creditors sales divided by the average accounts receivable. A higher ratio means faster collections, more efficient credit policies, better cash flow. So therefore, a high ratio is actually desirable and not undesirable. When you talk about the interest cover ratio depends on tax rate, this is incorrect. Why? Because interest coverage ratio measures how easily a company can pay its interest expenses. So when you talk about the interest coverage ratio, you will get that interest coverage ratio equals to earning before interest and tax divided by interest expenses. So when you talk about earning before interest and tax, this equals to earning, okay, I've already said that. So since the taxes are excluded from the earning before interest and tax, the tax rate has no impact on this ratio. So this statement is false. And the other statement, which states that increase in net profit ratio means increase in sales, this is incorrect. Why? Because the net profit ratio measures the profitability relative of sales. So the net profit ratio is equals to net profit divided by sales times 100. So an increase in its ratio can be due to increased sales or reduced costs or expenses. Therefore, a higher net profit ratio does not necessarily mean sales have increased. It might just mean that the company is managing its costs better. So hence the statement is not always true. It's factual, it's true, but it's not the guaranteed. It can be either that the increase, there is an increase of the profit ratio because yes, there are increased sales, or it can be a reduction in the cost and expenses. Question number 13. Financial intermediaries do not invest in new long-term securities. Financial intermediaries either do not invest in new long-term securities, include insurance companies and pension funds, include the national and regional securities exchange, are usually underwriting syndicates. Now, financial intermediaries include insurance companies and pension funds. This means that financial intermediaries are institutions that act as a bridge between the savers, those who supply funds, and the borrower, those who demand funds. So they channel funds from those who have surplus capital to those who need capital, helping to allocate financial resources efficiently within the economy. Examples of financial intermediaries can include the commercial banks, the credit unions, insurance companies, the pension funds, the mutual funds, and the likes. So insurance companies and the pension funds collect money from policyholders and members, respectively, and invest it in financial assets like stock, bonds, etc., to generate returns. So this investment creativity classifies them as financial intermediaries. So the financial intermediaries, our best option answer includes insurance companies and pension funds. When you look at the other options, like for example, you say that financial intermediaries do not invest in new long-term securities. That is incorrect. Many financial intermediaries do invest in long-term securities like government bonds, corporate bonds, and even equities. For example, pension funds often invest in long-term assets to meet future obligations. So this statement is false, and they do invest in long-term instruments. The other option states that it includes the national and regional active security exchange. That is incorrect. Security exchange like the Nairobi, like the New York Security Exchange, the Nairobi Security Exchange are not financial intermediaries. They are marketplaces where buyers and sellers of financial instruments come together to trade. So exchanges facilitate transactions but do not channel funds from savers to borrowers directly. Hence, the statement is incorrect. When you talk that they are usually underwriting syndicates, that is incorrect. Underwriting syndicates are temporary groups of investing banks or underwriters formed to help companies issue securities. So they help distribute new securities, but not financial intermediaries in the traditional sense. So their role is more of a facilitator in capital raising and not in long-term fund intermediation on that. So our option is the financial intermediaries include insurance companies and pension funds. Question number 14. Kitenge Limited is considering borrowing 10 million for 3 years at an annual interest rate of 6%. The loan agreement calls for 3 years, equal payments to be paid at the end of each year of the 3 years. The payment will include both principal and interest. What is the annual payment that will full pay off, amortize the loan? Now, to determine the annual payment that will full amortize the loan, that is including the principal amount plus the interest, we can use the loan amortization formula. We have the formula there. This is the formula we are going to use, where where PMT equals to the annual payment, the P represents the principal, the R is the annual interest, and of course the N is the long term years. Now, step-by-step calculations, we start by plugging in the values. So, we are looking for the annual payment that is supposed to be paid in amortization. So we'll start with the principal. We have said the loan that was borrowed is he borrowed a 10 million loan. So we have our 10 million there. The annual interest is 6%. We have been told it's 6%. So times 0.06 according to the formula. So we put that then into brackets 1 plus 0.6%. It's supposed to be paid in the period of 3 years. You divide by the formula 1 plus the rate into raised to power 3 minus 1. The calculation of 1 plus r raised to power the period 1 plus 0.06 raised to power 3, you are going to get 1.19 when you're using your calculator. So you substitute back into the formula, that is 10 million times the rate of 0.06 times 1.191016 over 1.191016 minus 1. So you'll get 10 million times 0.07. I had calculated it earlier, so you can follow up with me. 7146096 divided by 0.1, you will get that, and then you will get the amortization amount will be 3,741,000. So the answer is A, 3,741,000. So this is how we do the calculations, so that we get to that answer there. Let's go to question number 15. The present value of a 5-year annuity which begins in 1 year's time, is 60,000 at a cost of capital of 5% per annum. What is the amount of the annuity? The present value of a 5-year annuity, which begins in a 1 year's time, is 60,000 at a cost of capital of 5% per annum. What is the amount of the annuity? Now here, to solve this, we need to calculate the annuity amount, given that the present value is 60,000, the number of years is 5 years, the interest rate is 5%, and the annuity begins in 1 year. That is the ordinary annuity. So the formula for presenting the value of an ordinary annuity is present value equals to, this is the formula. We have that, where the present value, PV represents the present value, A represents the annual annuity payment, what we are solving here. R represents the interest rate per period, that is 5%, as we have been told. The N represents the number of the periods. So we go step by one, plug the values to the formula. The present value is 60,000 equals to sign to annuity times 1 minus 1 plus 0.5 raised to power negative 5 divided by 0.05. You do that calculations. Let's do this calculation here. You will get 0.7835. Still we continue. You apply the formula. If you times the raised to power 5, you will get that. Divide by that. 60 equals to 0.2165 divided by 0.05. 60 equals to A times 4.3291. So what you can do, this is 4 times, that is A 4 times. You can divide this by the 4 times. You can divide this. This comes to A 4.3295. Divide by that 4.3295. Divide by 4.3295. You will get 13,860. So the annual annuity payment will be 13,860. Number 16. Which one of the following statement is reasonable? Is a reasonable conclusion if intrinsic? Which one of the following statements is a reasonable conclusion if the intrinsic value of a stock is greater than its market value? Which one of the following statement is a reasonable conclusion if the intrinsic value of a stock is greater than its market value? So the stock has a low level of risk. That is first option. Second, the stock offers a high dividend payout ratio. The market is undervaluing the stock. The market is overvaluing the stock. So the best option is that the market is undervaluing the stock. Why? Now, when you talk about the market is undervaluing the stock, the intrinsic value of a stock is the estimated true value of the stock based on the fundamental analysis, such as future earnings, dividends, and even growth potential. So it reflects what the stock should be worthy according to an investor analysis. So the market value is the current price at which the stock is trading on the stock exchange. So if intrinsic value is greater than the market value, it means that the stock is undervalued by the market. It is trading at a price lower than what is its truly worthy. So therefore, C, the market is undervaluing the stock, is the correct answer, whereby investors may view this as a buying opportunity, expecting the market to eventually recognize the stock's true value and the price to rise. So when you talk about the market, when you talk about which one of the following statement is a reasonable conclusion, if the intrinsic value of stock is greater than its market value, the market is undervaluing the stock. When you look at the other options, the stock has low level risk. This is not necessarily true. The intrinsic value Being higher than the market price does not directly indicate that the stock risk is level. That does not indicate the stock is risk level. Risk depends on the factors like volatility, debt levels, industry, and the likes. When you talk about that the stock offers a high dividend payout ratio, also it's not necessarily true. A stock can be undervalued regardless of whether it pays high or low dividends. So intrinsic value is based on the overall fundamentals, not just dividends. When you talk about the market is overvaluing the stock, that is incorrect. This will be true if intrinsic value is less than the market value. But the question says that intrinsic value is greater. So the opposite situation. So the best option or answer here is that intrinsic value of stock is greater than its market value. That means that the market value is undervaluing the stock. Question number 17. When the required rate of return of the market of bond X is much less than its coupon rate or coupon rate, much lesser than its coupon rate, bond X is said to be selling at. When the required rate of return of the market bond X is much lesser than its coupon rate, bond X is said to be selling at discount, premium, face value, a price that cannot determine without more information. It's said to be selling at a premium. Why say that it's selling at a premium? When the coupon rate of a bond, that is the interest the bond pays, is higher than the required rate of return, that is the market interest rate, the bond becomes more attractive to investors. As a result, investors are willing to pay more than the bond's face value to receive those higher interest payments. So this situation causes the bond to trade at a premium. So investors are willing to pay more than the face value for the higher income. Like example, bond pays 8% market 8%. Market rate is 5%. Bond sells at a premium. When you talk about bond selling at a discount, a bond sells at a discount when the coupon rate is lower than the market interest rate. That is the required return. It means that investors want a higher return, so they are only willing to pay less than the bond's face value. Example, bond pays 4%, the market requires 6%. The bond sells at a discount. When you talk about the face value, that is per value, the bond sells at face value when its coupon rate equals the market rate. There is no reason to pay more or less than the bond's nominal value. Example, bond pays 6%, the market requires 6%. The bond sells as per the face value. When you talk about the price that cannot be determined without more information, this option is incorrect because you don't need more information if you know that the market rate is much less than the coupon rate. That alone is not enough. That alone is enough to conclude that the bond will sell above par. That is the premium. So the best option is that when the required rate of return of the market bond X is much less than the coupon rate, the bond is said to be selling at a premium. Question number 18. The cost of equity is given by D1 P0 plus G. What does G represent in the equation? The expected appreciation yield from the ordinary shares, the expected dividend yields from the ordinary shares, the dividend yield from the preferred shares, the interest payment from the bond. The answer is A, the expected price appreciation yield from ordinary shares. G is the expected growth rate in dividends, which reflects the capital gain or price appreciation. So the formula is known as the Gordon growth model or the dividend discount model, which states that the the price equals to the dividends divided by the cost of equity minus the expected growth rate. This is used to estimate the required return of stock given its expected dividend next year, the current price, and the growth rate. Like for example, in your calculations, suppose that the current stock price is selling at 50. The next year dividends will be 2.5 shillings. The expected dividend growth rate is 5%. So if you take the dividends divided by the stock price plus now then the expected growth rate, you will get the cost of equity is going to be 10%. Now, when you talk about the expected dividend yields from ordinary shares, this option 2, if we discuss all the options, this refers to dividends divided by the price, not the growth rate. So dividend yield shows how much return an investor expects from dividends alone, not from the growth. The dividend yield from the preferred shares typically pay fixed dividends and are not part of the Gordon growth model, which is used for ordinary or common shares. Also, preferred shares often do not grow their dividends, so G will not be zero for them, or will be zero for them, that is it. The interest payment from a bonds pay interest, not dividends. The Gordon model does not apply on bonds, and G has nothing to do with the bond interest. So the best alternative is that G represents the expected price appreciation yield from ordinary shares. Question number 19. Which one of the following types of risk is avoidable through proper diversification? Which one of the following types of risks is avoidable through proper diversifications? We have portfolio risks, systematic risks, unsystematic risks, and total risk. Now, when you talk about proper diversification is a risk mitigation strategy or a risk management strategy that involves spreading your risks across a wide variety of assets so that the poor performance of one investment does not heavily impact the overall portfolio within your organization. So it's a situation whereby, like for example, a company investing in education sector, in the medical sector, in a manufacturing sector, in real estate, and the likes. So you are trying to manage you are trying to do diversification. You are investing in different industries. So think like the building is safety net. If one or two investment fails, the other one can cushion the loss. So proper diversification means that investing in a variety of assets across different platforms like industries like technology, healthcare, energy sector, assets like stocks, bonds, real estate, geographies like in US, you invest in Europe, in Africa, and all that. If you see like the other guy who was being tendered by the government, Adani, you could hear that guy has invested in different sectors. He's invested in transport, supply chain that he was doing on the Adani on the airport. He was winning that tender for renovation or management of the airport. He's investing, we are told, in the system. He was the one in the health system. He was mentioned in, although I'm not sure on that, it was mentioned in the scandal of on the cost of managing the share stuff and stuff like that. So you can find that the mitigation kind of risk, that is diversification. Aga Khan, talk about Aga Khan. Aga Khan has invested in health sector. Aga Khan has invested in education sector. Aga Khan invested in the news sector. They are running the nation media and different industries. So the idea is don't put all your eggs in one basket. By spreading investments, the investor reduces exposure to any single economic event or the company performance. This helps reduce unsystematic risk. So the answer is unsystematic risk. And when you're talking about unsystematic risk, also known as diversifiable risk or a specific risk, refers to the risk that is unique to a particular company or industry. This includes like poor management decisions, product recalls, labor strikes, regulatory issues affecting the single firm and all those. So unsystematic risk arises from company-specific factors like management decision, lawsuits, product failures, industry downtowns, and all those. But when you look at other factors, other options, when you talk about portfolio risk, that is incorrect because portfolio risk includes both systematic and unsystematic risk. While diversification reduces unsystematic risk, systematic risk still remains. So portfolio risk cannot entirely avoid through diversification. When you talk about systematic risk also referred or called as a market risk affects all securities in the market, like inflation, interest rates, recession, geopolitical events, and all those. So this risk cannot be avoided through diversification. It affects the entire market. So whether you are in all those industries, when these risks happen, all those industries are affected. Like for example, if you look at, if you are all those industries, then a pandemic like COVID-19 comes, it affects all the industries. And when you talk about total risk, that is incorrect because total risk equals to systematic risk plus unsystematic risk. So diversification can reduce the unsystematic risk, but not systematic risk. Therefore, total risk cannot be entirely avoidable through diversification. And number 20, which one of the following is a statistical measure of the degree to which two variables such as securities return move together? We have variance, covariance, coefficient of variation, and the certainty equivalent. Covariance is the best option, is the best answer. So covariance is a statistical measure that indicates the degree to which two variables move together. So if covariance is positive, the two variables tend to move in the same direction. If covariance is negative, they tend to move in opposite direction. If it's close to zero, there's little to or no relationship in their movements. So in investing, covariance helps determine how two securities move relatively to each other, which is essential in portfolio diversification. But when you talk about variance, variance measures how much a single variable, like stock return, diverts from its mean, not about two variables. When you talk about coefficient of variation, the coefficient of variation is the ratio of standard deviation to the mean, often used to compare the risk per unit of return. So you will find that coefficient of variation equals to standard deviation divided by the mean. This is used for comparing risks across different investment and not how two variables move together. And when you talk about the certainty equivalent, the certainty equivalent is the guaranteed amount of money an investor will accept instead of taking the risk investment. So it's part of the decision theory and utility models, not a statistical measure of core movement. So it helps understand the risk preferences, but does not or doesn't involve correlation or joint behavior of variance.